We will now shift gear to the financial and investment aspects for the industry. What are the investment strategies that are required to support the growth in the chemical industry? The theme of this presentation is Shift in Growth Strategies of Emerging Market Players. We will be now hearing from Mr. Hugo Heath, who is the head of the corporate sector group at HSBC. Mr. Heath has over 29 years' experience in the investment banking and has focused on the chemicals industry for the past 20 years, working across all segments of the industry on a variety of advisory and financing assignments. Please welcome Mr. Heath.
Thank you. Your Highnesses, Your Excellencies, Mr. Al-Mahdi, distinguished guests, ladies and gentlemen. Yes, the topic today is the shift in growth strategies of emerging market players, specifically focused on the chemical sector and particularly the petrochemicals elements of that. Let's look at the successful growth models of emerging market players over the last 15 years. There have been different models for different regions. In Latin America, the focus was on capturing domestic growth and servicing the North American market. In the Middle East, built around competitively priced feedstock, economies of scale, and an export-driven model. China, to service the incredible growth that they were experiencing over this period of time. Korea to service that market largely. India with its own growth. And Southeast Asia, where the model has been focused additionally on servicing large markets like Indonesia and Vietnam, where capacity is limited. So in summary, you have a collection of domestic or regional strategies founded on organic growth and the build-up of manufacturing capacity. Sorry. These strategies have delivered great success, as measured by gains in market share. If we take ethylene as a proxy for the market for which data is available, and we look at the situation in 2000 and we compare it with the situation now, you will see that in 2000, whereas emerging markets constituted 30% of the installed base of ethylene production, today it is 50%. At the same time, the developed market has decreased from 50% to 35%, and this is in a period of time in which the overall capacity has increased by 50% over those 14 years. So significant market share gains. Another criteria is capital market scale. In this slide, we plotted a collection of the larger petrochemical-oriented companies for which data is available. And I just should explain that. That means that unlisted companies like the chemicals operations of oil companies, particularly Chinese groups, are not included. We also excluded groups which are not really involved at all in petrochemicals, like industrial gases and coatings. So it's a collection of companies. What's really striking is that the developed market players are shown in blue, and the emerging market players, Middle East, Asia, Latin America, are shown in orange. A staggering number. The largest on the list here is SABIC, but even groups like Tasni in Saudi Arabia and Petronas Chemicals in Malaysia are now of a capital markets scale and size equivalent to DSM and Huntsman. And we looked at earnings growth. We looked at, for largely the groups you saw before, the aggregated EBITDA is a proxy for earnings, of the developed market groups and the emerging market groups. The developed market groups, over the period 2007 to 2013, grew EBITDA by 30%, including the dip in 2009. Emerging market groups grew by 50%. And that's pretty impressive when you realize that the data we're showing you here excludes a number of those Chinese and Indian groups for which data is not available. And, importantly, for the emerging market groups, it doesn't include acquisitions. It's all pretty much domestic growth. Whereas the developed market players have been heavily reliant on acquisitions. So we actually tried to strip out the acquisitions, and we saw that by our crude calculation, the growth for developed market players, ex-acquisitions, was actually 20%, so even lower. So what about where we're going from here? Well, there's a bit of a slowdown for the developed market players. Over the period 2013 to 2016, equity research analysts predict that EBITDA growth will actually grow by 16%, so a slower rate than the previous period. And that's notwithstanding a recovery in Europe and the US, and it's notwithstanding US shale gas. But what about emerging market players? Well, they're actually losing ground. The same group of companies I showed you, the very impressive story we looked at in terms of their arrival on the international stage, are going to grow EBITDA under their own steam by 9% over that period. So for emerging market players, what's changed? Well, first, we've got low growth in the West. No surprise to you. North America and the Eurozone at a very subdued rate. But we've also got decelerating growth in the emerging markets. China down to 7%, Brazil operating at 1 to 2%, and only India showing some recent growth around the new agenda for the new government. Second, the emerging markets are no longer the only prime destination for investment. If we look at ethylene capacity additions in the period 2007 to 2013, there was approximately 29 million tonnes of capacity added. That's about the same amount as is predicted to be added in the period 2013 to 2018. What stayed the same is that China is responsible for 10 million of those tonnes, both backward-looking and forward-looking. But what's different now is whereas the Middle East built 15 million tonnes of ethylene capacity in the historic period, it's forecast to build 6. And I do recognise that the focus here is to move further downstream, but as a proxy for investment, this is a pretty good one. Whereas North America is forecast to add 8 million tonnes, even more than the Middle East. Third, traditional regional growth opportunities are drying up. In Latin America, shale gas in the US and domestic growth are having a retarding effect. In the Middle East, availability and sometimes uncertainty with respect to feedstock, and the challenges of pushing the cost advantage down the chain, plus decreasing oil prices. And in Asia, the increasing self-sufficiency of China. And everybody is chasing those markets. So, what's next for emerging market players? Well, firstly, emerging market players, and specifically here in the Middle East as well, are going to focus harder on the existing asset base, making the most of what you've got. People will increasingly look at mergers and consolidations to increase scale, pool resources, and deliver synergies. And there will be an increased focus on the bottom line rather than the top line. Second, whereas in the past emerging market players have had a growth strategy focused on bringing capacity on domestically, increasingly international growth ambitions will need to be satisfied. Third, there will be an increasing focus from a manufacturing focus to technologies, differentiated technologies, getting closer to the customer, and that will respond and that will be reflected in the acquisition or development of technologies, applications development capabilities, and access to markets, as I said, mostly by getting closer to customers in the way that Western companies do today. And that will largely have to be realized through acquisitions. Difficult to grow this one on your own. So, to summarize, for emerging market players, increasingly a focus on existing assets and operations and getting more out of them. Increasingly an international focus for the business, the development and acquisition of new skills, technologies, and access to markets thereby, and increasingly looking for growth strategies incorporating, most importantly, acquisitions. And guess what? That looks a lot like the strategies of the Western groups. It's going to get quite crowded.